You're in a cafe with 2 passports, 3 bank apps, and a latte you forgot to drink. A push notification pops up from a bank in another country. Incoming wire received. You feel rich for 4 seconds, until a colder thought lands. Do I have to report that? To whom? How? And will some tax office think I'm laundering money when I'm just moving my own savings? Start with the basic map. 2 systems watch cross-border money. One is tax, whose job is to count income and gains so the right country can tax the right thing. The other is currency control and anti-money laundering, whose job is to know who moved what, from where, and why. They overlap, but are not the same. Tax asks whether you earned or realized a gain. Currency control asks whether you obeyed the rules for sending, receiving, converting, or holding money in or out of the country. You can be squeaky clean on tax and still trip an AML alarm because your wire memo said gift lol. You can also follow every currency rule and still owe tax because a transfer is an income, but the thing you sold to fund it created a gain. Now let's talk about the world's loudest lighthouse, automatic information exchange. Decades ago, a bank account abroad was a quiet shoebox. Today, most of the planet runs on information treaties. If you're a US person, FATCA tells foreign banks to identify you and report account data. If you're almost anywhere else, the Common Reporting Standard tells banks to send your details to your home country through an annual data fire hose. That's why the modern strategy is not secrecy, it's tidiness. Assume your home country already knows the headline numbers. Your job is to make your story coherent when the letter arrives. If you're a US citizen or resident, you live with 2 pillars. One is the Foreign Bank Account Report, FBAR, filed with the US Treasury, not the IRS. It's triggered by the high watermark across all foreign accounts if the combined peak ever crosses a fairly modest threshold during the year. It's informational. No tax is calculated on that form. The other is Form 8938 under FATCA, which rides with your tax return and asks about foreign financial assets when they exceed set totals that vary depending on filing status and whether you live in or outside the US. People confuse these constantly. Think of FBAR as tell Treasury where your accounts are, and 8938 as tell the IRS about your foreign financial assets. They overlap, but they're not duplicates. Sometimes you file both, sometimes only one. Miss them, and penalties are not the kind you can explain away with a shrug. File them, and most drama evaporates. If you live in the UK, your life is simpler and trickier at the same time. HMRC wants to see worldwide income and gains if you're UK resident under standard rules. If you claim the remittance basis as a non-dom, offshore income and gains may avoid UK tax until they're brought to the UK, but the price of that privilege grows the longer you stay, and mixed funds can turn a simple transfer into a color-coded puzzle. The UK also participates in the Common Reporting Standard, so offshore banks whisper to HMRC each year. Transfers themselves aren't taxable. What matters is the source. Send $1 million of clean tax capital to London, and HMRC yawns. Send 1,000 of untaxed interest disguised as loan from cousin, and HMRC wakes up. The difference is paperwork and truth. If you made Spain your base, you've heard the words Modelo 720 whispered like a bedtime story with a jump scare. It's not a tax. It's a disclosure of assets held abroad above certain thresholds. Bank accounts, securities, real estate. Spain has softened the once draconian penalty regime after court challenges, but the form still exists, and the expectation remains. If you're a resident and you hold substantial assets abroad, you tell them. Spain also watches foreign crypto with a sibling form in many cases. Again, the point is not to tax movement. It's to map it, so later tax on income and gains has a clear trail. Canada stamps its mark with the T1135, an annual disclosure of specified foreign property over a threshold. Australia expects you to include foreign income and gains and has robust data matching. Many EU countries have their own foreign asset disclosures or simply rely on CRS inflows and cross-check your return. The melody is constant. If you're resident, worldwide stuff matters. If you hold assets abroad, you disclose. And if you move money across borders, the transfer is not itself income, but the thing that created the money might have been. So what counts as income and what is just moving boxes around the attic? A wire transfer is never taxable just because it moved. Tax tracks events, not pipes. If you sell stock in country A, the gain is taxable according to your residence and treaty rules. When you later transfer the proceeds to country B, That's a relocation of money, not a new gain. If you receive interest in a foreign account, the interest is income when it was credited, even if you never repatriated. If you convert currencies and make a profit because exchange rates moved, some countries tax that as a capital gain, especially when you're holding currency as an investment or as part of a business. Others ignore personal use FX. Know your local rule before you brag about your heroic dollar-to-yen trade at dinner. Loans and gifts deserve their own spotlight because they look harmless and cause the most pain. If your parent overseas wires you funds, that may be a non-taxable gift in your country. But some countries require you to report large foreign gifts or bequests even when no tax is due, and your bank may still ask for source of funds proof. If you borrow from your own company abroad, that's a loan on paper. But if terms are fake or you never repay, the tax office may reclassify it as income or a hidden distribution. If you lend to your own company, interest may be taxable to you and potentially deductible to the company if the terms are arm's length and thin capitalization rules are respected. Write a real loan agreement, set commercial terms, document payments, and keep bank evidence that the cash moved as the contract says. Let's talk currency controls. The family of rules that limit or monitor how residents can send or hold money abroad and how non-residents can bring money in. In many developed markets, currency controls are light. Your bank performs AML checks and tax authorities worry about income. In other places, residents must register foreign accounts, report outbound transfers, stay within annual remittance caps, or route payments through licensed banks with government forms. If you move to or do business in a country like that, your task is not to outsmart the gate. It's to walk through it correctly. Use the official bank channels. Fill the forms. Keep the approvals. Don't split a large transfer into cute little slices to avoid a threshold. That pattern has a name, structuring, and compliance teams are trained to spot it. Transfers through fintech platforms add modern flavor. Payment firms file reports too. If you park balances in a multi-currency wallet, treat it like a bank account for reporting purposes when the law says so. If the platform statement shows interest or cashback, that's income. If it shows fees or FX spreads, those are costs that matter for business books, and sometimes for capital gain calculations. If you hop balances through 3 wallets to keep it simple, you didn't. You created 3 audit trails. Keep one master ledger of movements with dates, counterparties, currencies, reasons, and links to statements. When a bank asks, you have answers. When a tax office asks, you have a story that makes sense. Crypto crosses both worlds at once. An exchange account abroad is often a foreign financial account for disclosure. On-chain wallets are not bank accounts, but many countries now ask explicitly whether you had crypto, received crypto income, or disposed of tokens. If you stake and receive rewards, expect income the moment you gain control, measured at fair value in your home currency. Later, when you sell the tokens, you calculate a capital gain or loss relative to that income basis. If you move tokens from one wallet to another you own, that's not taxable. If you swap one token for another, that often is. If you cash out to a foreign exchange and wire the money home, the taxable moments were the swaps and disposals along the way, not the wire. The solution is timestamps and values, not vibes and hope. Here's how you keep this entire circus calm. Decide where you are resident for tax this year using the real tests in your country. Days, home availability, center of vital interests, habitual abode, tiebreakers. Once you know that answer, write one paragraph to yourself that says where you lived, where you worked, and which countries could plausibly claim you. Keep it in your files. List every foreign financial touchpoint you had: bank accounts, brokerage accounts, exchange accounts, custodial wallets, life insurance wrappers, foreign pensions. Note their peak balances for the year and whether they paid income. That list is your starting grid for FBAR type or foreign asset disclosures and for income reporting. Gather the proofs before you need them. Save year-end bank statements and mid-year screenshots showing the high water mark, because FBAR style forms care about peaks, not just 31 December. For transfers above whatever your bank calls large, save the invoice, contract, or gift deed that explains the reason. For loans, keep signed agreements and an amortization schedule. For gifts, Write a short letter from the donor that says it's a gift, and keep identity and source of funds evidence if a bank asks. For FX conversions, capture the rate and fee so you're not guessing later when you reconcile why $97,800 arrived from a $115,000 sale. Learn the difference between reporting and tax. The scary forms mostly demand disclosure, not payment. FBAR wants account details. FATCA wants asset categories and totals. Spain's big form wants positions abroad. Canada's wants specified property lists. Failing to file can be expensive even when no tax is due. Filing on time turns alarm bells into yawns. File the disclosures and then report the actual income and gains on your return where the math belongs. If withholding happened abroad, keep the statements. Those credits often save you from double tax. Manage your narrative across institutions. Wires and compliance are about consistency. The invoice says consulting fee. The memo on the wire says consulting fee. Your return shows consulting income. Your contract folder holds a scope of work, and your calendar shows the project occurred. That's what a risk team calls a low-friction customer. The opposite is a wire memo that says gift, a contract that says loan, a return that says nothing to see here, and a string of split transfers just under every threshold. That's how you buy yourself a long winter. Remember that moving money between your own accounts across borders is not a tax dodge. It's a bank compliance story. If your home country taxes worldwide income, it doesn't care which account received interest. It cares that you included it. If your home country taxes only remittances, like the UK remittance basis, it cares a lot about which money you brought in. In that special case, don't mix clean capital with unremitted income in the same account. If you already did, talk to someone who knows the mixed fund rules before you move another pound. Sometimes a bit of planning and a new account prevent a year of sorting spaghetti. Don't improvise with cash. Cash deposits are the least persuasive evidence on earth. If you must use cash for a local reason, write yourself a memo, keep the receipt, and expect questions if amounts are large. Better, wire through banks so you have a crisp trail. If you're starting a business that will live in one country and sell into another, design payment flows on paper first. Decide which entity invoices, which account receives, where you hold operating currency, and how and when you repatriate profits. Read your home country's rules on controlled foreign corporations or similar anti-deferral regimes so you don't accidentally create a box that taxes you on income you never touched. If you want to use a low-tax hub, make the substance real. People, decisions, contracts, and a genuine business purpose. The world is allergic to shells that only exist to reroute money. Speak to your banks as if they're smart, because they are. If you intend to move a significant amount, tell them ahead of time. Provide documents before they ask. Use precise memos. Respond quickly when compliance pings you. A happy bank is a superpower. A frozen account is a lifestyle. Build the month-end ritual that keeps you sane. On the first weekday after month-end, download bank and card statements for every account, including foreign ones. Save exchange statements and wallet exports if you touch crypto. Update a simple spreadsheet with columns for date, from account to account, amount, currency, purpose, and link to the supporting file. Note the month's high watermark for each foreign account. If a transfer was unusual, write one line that explains it while your memory is fresh. If you crossed a disclosure threshold this year, put a reminder on your calendar for the filing window so it doesn't sneak up on you. This isn't busy work. It's a $1,000 problem solved in 5 minutes because you wrote down the truth at the right time. There are myths worth retiring. If I keep it offshore, it's not taxable. If you're resident in a country that taxes worldwide income, offshore is just geography. If I split wires into small amounts, nobody notices. Computers don't drink coffee. They notice everything. If I call income a loan, it becomes a loan. If there's no obligation to repay on commercial terms, it's not a loan. It's a story. If I didn't bring it home, it's not income. Sometimes true in narrow regimes like remittance basis rules, generally false elsewhere. If I filed my return, I don't need to file the separate foreign asset disclosure. Apples and oranges. Do both if you're required. What if you already missed a form? Breathe. Most systems let you fix honest mistakes. File late, explain, and keep going. If you knowingly omitted accounts or income, talk to a professional about voluntary disclosure paths. Many countries reduce penalties for speed, completeness, and cooperation. The worst decision is silence after the letter arrives.